Hello, what's up guys? My name is Ibadur Rahman. Welcome to my channel Finico. In this video, we are going to go through the world of option trading strategies, and you need not worry if you do not know what options are. I was in your position not a long time ago. My goal and my mission throughout this video is to touch the important concepts of option trading strategies, where I would illustrate it with examples in order to broaden your scope better. So without any further ado, please grab your favorite meal or your drink, because one thing I can promise you, that this is going to be a long video since we have a lot to cover. So without any further ado, let's go. Options. Before I can go on to hit the definition of options, what do you think options really are? Exactly. Option gives you an option to do something or not to do something. And that is what the definition of option is. It gives an individual, an investor, a trader a right, but not the obligation to exercise the very option at a strike price. In other words, option is a financial derivative. What is a financial derivative? It is a financial contract, and the value of the financial contract depends upon the underlying value of the asset. Over here, the asset means an equity. The second important part of options is your expiration date. Okay, what is an expiration date of an option? You have two expiration dates: American option and European option. American option goes on to suggest, and for the basis of simplicity, let's take a particular month, January. Your 1st Jan all the way to 31st Jan. With an American option, you can exercise your option anywhere from 1st to 30th. Okay, 31st, sorry. From 1st to 31st. You can exercise your option anywhere from 1st to 31st with an American option. However, with the European option, you can only exercise on the 31st. All right? Now, what do I mean by exercise? Right? That might be in your question. Exercise. What does exercising an option means? You see, in option, there is something known as a strike price. And strike price is basically which gives the trader and investor the right but not the obligation to buy or sell the share of stock at its strike price. Now, for this basis, for this example, I'm going to take one of my favorite stock, yet the controversial stock. You guessed it right, Tesla. Now, as of 2nd December 2021, Tesla was trading at $1,095. Let's take the share price of Tesla at $1,095. Your strike price is at $1,000. Now, if I have a call option, that basically means I as an individual, I as an investor, I as a trader can go on to buy Tesla at the strike price. Even though Tesla is trading at the share price $1,095. You want to know why? It is because I have gone on to exercise my option at the strike price since I have the contract and I've bought the contract. How have I gone to buy the contract? Something known as a premium. But before the premium, there is something which is a price of an option. Now, Tesla options are absolutely expensive. Okay, you can just go on to check through the price in any of the brokers' account, be it the Interactive Brokers, Bloomberg Terminal, or Market Map. But to keep this thing simple, and for the sake of simplicity, let's take the option price at $5. Now, an option, you have something known as an option contract multiplier. And by the option contract multiplier, what exactly you do, which probably might be a bit difficult, but bear with me, you will understand. 5 into 100 will give you 500. This is your premium, which you need to pay in order to exercise the option at $1,000 for the strike price. And I have definitely gone on to I've absolutely forgotten to mention this, that if you are a call option holder, then you are bullish in the market. And what I mean by bullish is that you expect your stock price, your share price to be above your strike price. Only then will you be able to exercise the option. Because think about this. And I will again give you a very great example after that, if for individuals who are very new to the stock market. If this very share price has gone all the way down to $900, would you invest your option? I mean, would you exercise your option at strike price at $1,000 when the value is at $900? You won't. Because if you're going to exercise your option at $1,000, you can always go on to sell it for $1,095. The difference is $95 in your account. But you might be wondering, I have told you about option contract multiplier. Voila. So in option contract multiplier, you always multiply things into 100. So basically your 1,095, your share price would be 1,095 into 100 would give you 109,500. Okay? And since you have gone to multiply your share price at 100, you obviously have to multiply your strike price at 100. Your strike price into 100, 1,000 into 100 gives you 100,000. If you go on to subtract 109,500 minus 100,000 gives you a figure of 9,500. All right, 9,500. By the way, if you guys remember, just a couple of minutes back, I went on to say that $95 is the money which you will go on to make. But by the option contract multiplier, if you're just going to multiply it into 100, it's 9,500, isn't it? But 9,500 is not the money you're going to make. 9,500 is your gross value. This is your gross value. The reason why is because you purchased your premium for $500, yeah? You need to take that into account. It's a cost. So 9,500 minus 500 gives you 9,000. This is your net value. This is your net value. This is the amount of money which you have gone to make. Okay? Now that's for the call option, guys. Again, I just want to repeat myself. Call option is when you're bullish in the market. When you expect the stock price to go up, and above. When you expect the stock price to go above your strike price. When your stock price is above your strike price, that is when you go on to exercise it. But there is one thing which I need all of you to understand when you do have to exercise and when not. You see, in options, there's something known as a break-even. And break-even, by most of you will understand, you do not make a profit, nor you make a loss. So what would be the break-even over here? The break-even would be your strike price, which is your 1,000, plus your option price, which is your 5. basically 1005. This is your break even. Obviously, when you go on to multiply this into 100, what do you get? You get 100,500. But this is, again, it's a bit confusing, but what I basically want to tell you, if your stock price is at 1005, which again is above the strike price, at this point of time, you do not make a profit nor you make a loss if you exercise it. But if you exercise at 1001 or 1002 or 1003 or 1004, you make a loss. Even though it's above your strike price, for the very simple reason that you need to take this cost. You need to take this into account. You need to take this $5 into cost. Okay? So that is basically your option price, and again, option price is when your call option is when you are bullish in the market, when you expect your stock price to go above your strike price, and as the stock price increases, so does the value of the option increases. Basically, your $5 would then go on to become $7, $8, $9, $10. And again, guys, remember, by the option contract multiplier, you always multiply it into 100. That's the rule of thumb. You always multiply it into 100. You multiply the price into 100 because, see, this is the option price. But you need to get the option premium. The premium is $500 when you multiply that into 100. At the same time, you also have to go on to multiply the share price into 100. You also have to go on to multiply your strike price into 100. Okay? All right. This is a lot of information. We definitely need to rub this thing off. Now, this is not a promotion, but I basically use a glass key cleaner because it works perfectly well for a whiteboard. But unfortunately, the whiteboard cleaner does not always erase well. So you really have got to use the glass cleaner, which can also work as a whiteboard cleaner. And it actually works perfectly well. I mean, yes, it is a mess. It really is a mess. But for that, I've got a towel in order to make sure that this mess goes away. Yeah? Now, put option. Put option is just on the contrary. It's just on the opposite. When you are a put, when there's a put option, you are bearish. You expect the company to perform bad. Okay? So, again, for the sake of simplicity, let's take the example of Tesla again. Tesla, as of 2nd December 2021, it closed at 1,095. Okay? Your strike price is the same for the sake of simplicity. This is your stock price. 1,000 is your strike price. Okay? If your stock price is above the strike price, you don't make money over here. You don't. But if the stock price comes below to 900 and you exercise your option, that is when you make money. The difference is 100. Right? The difference is 100, and obviously by the option contract multiplier, when you multiply this into 100, then you get 10,000. 10,000, but again, always remember, guys, you then need to multiply your stock price into 100, you then need to multiply your strike price into 100 in order to get the net value. But basically, your put option is all about you want the stock to perform less. Okay? And there is something known as intrinsic value, which I will hit into that very, very soon. But what I basically want to tell you guys is this is your potential stock price. As further down it goes, to 800 to 700 to 600, you make money. In other words, you are in the money. Okay? So we have covered put option as well. We have covered option contract multiplier as well. All right. Okay. Now, again, very important concept is that in the option trading strategy and option pricing strategy, what they are. You see, according to the option pricing strategy, every option has a benefit and a profit which lies embedded towards the owner, investor, or trader if he or she goes on to exercise the option. But according to the option trading strategy, the same profit and benefit is embedded towards the owner if he or she does not exercise the option, but makes the profit out of the value or of the change in the value of the option. Now, what does that mean? When I say, guys, change in value of option, I basically mean the option price. So, standard, to make it simple, option price is 5. Okay? For your call option, if you're a call option holder, you are bullish in the market, you expect the stock price to go above the strike price. Basically, it's going up, up, up and above. Okay? Then your option price will increase. This will go on to 6, 7, 8, 9, 10, so on and so forth, as long as the option price increases. For the put option, if your stock price increases, your option price will decrease. Your option price will become lower. 5, 4, 3, 2, 1. But if your stock price decreases to your strike price, becomes 900, 800, 700, 600, your option price increases. 6, 7, 8, 9, 10. And how do traders make money out of it? Because they buy at 5 and they sell at either 6, 7, 8, whatever the price of the option is. And say if things went not as planned, not as anticipated. Say that if you're a call option holder and the stock price went below the strike price. If you're a put option holder, your stock price went above your strike price. Then what do? Then you basically don't do anything. You don't exercise your option. Your loss would be your 5. Basically, you're into option contract multiplier. 500 would be your loss. Okay, that is, and again, you might be thinking, well, why is it? Why do we go on to not exercise the option? 99% of the time, traders and investors do not go to exercise the option because the amount of money one actually needs to spend. I mean, can you believe that in order to get 109,500, you need to buy into 100, basically your strike price, $100,000 is what you need to invest. Where you can go on to trade for 5, and again, 5 is something which is, this is a very inconsequential figure. Most of, stock like Tesla really trades at like 92.89 price, which into 100 gives you 9,289 premium. And if it goes up, up, up and above, let's say for example, it has done extremely well, your price could probably be 103.89. This then goes on to become 103, basically 10,389. You do the difference, that's the profit you're going to make. And as trader, you're going to invest into lots of options. So options are absolutely risky instrument. Financial derivatives by nature, it is a very risky financial contract to get into because you are leveraged, but at the same time, if things goes well, you can make immense amount of profit out of it as well. Now, the great thing about it that I'm sure you guys do remember that I said that I will illustrate a great example about it, because not many individuals like me once upon a time, I really do not know a lot about the share market. So something which all of us we know and all of us are fascinated about is real estate, is house. Don't each and every one of us wants to own a house? Since let's say that if the share price did not go on to make much sense, let's take an example of the house, shall we? Okay. So take this absolutely beautiful house. Now take this as a house. Say for example, you as an individual want to purchase this house, but 2 years from now, not now, 2 years from now, you get into an option. You get into an option, price is $100. Okay? Option price is $100, basically into 100. That basically gives you $10,000. That's your premium. Sorry. And your house is, at that point of time, is $200,000. When you have gone on to create an option. Now 2 years from now, the price of the house increased to $350,000. 2 years from now. And in 2 years, if you want to purchase either by the American call option or the European call option, which is at the last date, but if you want to purchase this, if you want to exercise it, at what price do you think you will exercise? Voila, you will exercise that $200,000 because you have entered the option contract. So what would be the amount of money which you have made? 350 minus 200 will give you $150,000. 150 minus $10,000 will give you 10K, will give you $140,000. I'm sorry guys, there's a lot of figures, but you can hear me well, hopefully. $140,000 is the amount of money which you have gone on to make. Now, let's say on the contrary, one needs to be pragmatic as well as a cynic. Say that if $200,000, if the price of the house has gone all the way down to $150,000, 2 years from now, do you go on to purchase the house at $200,000 or $150,000? You will cancel your contract, you will not exercise your option, and you will buy the house at $150,000. What is your loss? Your loss is only, that's the beautiful thing about option, because it gives you the right, not the obligation. You lose $10,000 only. And again, when I say only, I don't, this is a significant amount of money. But what I'm trying to tell you is that if things don't go as planned, if things go south, then you transact, what you lose is your premium. Okay? Okay. So we have touched this into it. All right. Okay. In the money, at the money, and out the money. What do I mean by this? Guys, whenever for a call option, if your stock price is above your strike price, you're in the money. Just think about it. You're simply in the money. And just by the word in the money, what does in the money signify to you? What does it tell you? What rings your ear when you say in the money? In the money, you're in the money, you're getting the money. So basically for your call option, it's at $1,095. $1,095 minus $1,000 is $95. By the option contract multiplier, then it's $9,500. You're in the money. For the put option, if your stock price goes below your strike price, is at $900, you're still in the money, because 1,000 strike price. Over here in put option, you do strike price minus your stock price, you basically get 100. Okay, and obviously into 100 would then give you a figure of 10,000. You're in the money. In the money is also known as intrinsic value. Intrinsic value. Intrinsic value means that you are in the money. Okay? And just by the word intrinsic, what does intrinsic means? A benefit. something which you are getting as a benefit. And what you get as a benefit is intrinsic value, which is in the money. Extrinsic value, okay? Extrinsic value has nothing to do with the performance of the underlying value of the asset, but has everything to do with the time value. Extrinsic means time value. So, you remember we said standard 1st January to all the way to 31st of Jan. So, if your date is at 1st, 2nd, 3rd, 4th of Jan, your extrinsic value is high. And what is the formula of extrinsic value? It's intrinsic value minus your premium. And for your intrinsic value, the formula is your stock price minus your strike price. For your call option, and obviously for your put option, it's strike minus stock. But see, there's a very important fundamental thing what I need to explain to you guys. See, even if the intrinsic value is 0, that does not mean that that very option is bad or it's sour. No. Because you really have to look at the time value. Say that if it has no intrinsic value. Say that, for example, 900 is a stock. You're a call option. 900 is your stock price. $1,000 is your strike price. You have 3 months from now. It's intrinsic value, but the extrinsic value is great. It's positive. You have the opportunity, and you've read through the news. You've gone through the financial statements. Very, very important. I mean, I can really go in length how important financial statements really are. You go through the income statement, you go through the balance sheet, you go through the cash flows, you read through the news, you go through the quarterly earnings, you follow the, as trader, we basically go through the technical analysis, you go to the moving average convergence divergence, you go through the relative strength index, you go through the histogram, you go through the Fibonacci, you see through what is the support and resistance, you see through if there has been a double top or if there has been a double bottom, you look at the trend analysis, and then that does not mean out of certain you will be right. But then with the fundamental and the technical analysis, you can draw some kind of a conclusion. Well, you know what? Because of these metrics, what I've studied, yes, the possibilities are this $900 at stock price can go above the strike price. Okay? Okay. So we have touched that. Okay. Now something very important, which I need to get into. Bear with me, okay? I know, it should have been better. Now, call option, bullish. You expect the stock price to go up. Put option, bearish. You expect the stock price to go down. Short, call option. You are bearish. You expect the stock price to go down. Short, put option. You're bullish. You expect the stock price to go up. I know it's a complete different thing, yeah? So what basically is short? Again, before I could get into this concept, I want to give you the knowledge of the jargons. Short in finance means sell. And long in finance means buy. When you're shorting something, which basically means you're shorting the call option over here, you are basically thinking and you're basically saying that, no, you know what? This stock is not going to perform well, just like the put option. But what the play over here, because you might be thinking that, why short call options? I mean, I can just do put option, yeah? But in short option, you see, I mean, remember we said $5. This is standard, by the way. This is your option price. This $5 you do not have to buy. This $5 you have to sell, and this comes to your account. Now what's the catch over here? Because again, I would not like to go into the option pricing strategy because this is more towards trading. What traders basically do is your option, your stock price, if it goes down, your premium, your option price goes down. Let's say that the option, this 1095 was your basically your stock price according to 2nd December 2021 Tesla. Okay, 1000 is your strike price. I should not have rubbed it, but fine, whatever. Stock strike. Now the new price is 900. When it goes to 900, you make money. When it goes to 900, basically, because how you make money is you have, this is in your account, but you need to buy it. You need to buy it, yeah? So this has gone to 3, 5 minus 3, 2, by the option contract multiplier into 100, 200. 200, voila. 200 is the profit you are going to make. For the put option, shorting put option, you're bullish over here. Same thing happened, guys. Same thing happens. $5 is sold to you. $5 comes to your account. And as the stock price increases, your option price decreases. Because what did I say in the start of the video? I said if you are call option, you are bullish. Call option is directly proportional to the stock price. The value of the option price, the value of the option premium by the contract multiplied into 100 will increase as the stock price increases. And the value of the option price, the value of the put option will increase as the stock price decreases. Over here, if your strike price is at 1000, it's 1095 right now. This goes on to become 2000. Elon Musk will be absolutely very happy. This goes on to become 2000. Your value of put option will decrease because by the put option fundamentals, it is inversely proportional, yeah? If the stock price goes above the strike price, that's not what the put option trader wants. They want it to go down, but you're shorting the put option, so you're basically selling it through. And that's the difference you're going to make. Now, let's say that if it goes on the contrary, again, 5 is your loss. $500 is your loss. This is the loss which you're going to make. Okay? Okay, right. Now I would like to get into the concept of implied volatility. Implied volatility. Now, when I say implied volatility, what do you think it means? Implied, by the definition, expected. Volatility, by the definition, magnitude of the fluctuation of price. It's volatile. So expected magnitude fluctuation of stock price. So say for example, if the implied volatility of share A, if the stock price of share A is $1,000, okay, and if then you have share B, which is at $100. If the implied volatility is 10% for both share A and share B, that basically means 1000 into 10%. This can go 100 plus, 100 above, basically 1100, or it can go 100 down, which means 900. But for share B, the implied volatility is at 10%. You do 100 into 10%, you get 10. This can go to 110 or this can go to 90. Now this is a significant difference. What a person needs to consider, what a trader or investor needs to consider with regards to the option price. With regards to the stock price. Because that goes on to implied volatility. But at the same time, guys, okay. The Visa share price as of 2nd December 2021 was trading approximately at, closed approximately at $190 per share. Visa closed at $190 per share. And Starbucks closed approximately at $109 per share, but we are going to take $110 per share. Okay, just for the sake of simplicity, let's just round out. Now you have 190 and 110. You see, there is not much of a really significant difference to 1,100. There's not much of a significant difference. But let's say that if you see the option price over here might be 5, and the option price over here might be 10. This basically goes on to suggest that your Starbucks is more volatile. The chances of increasing in the share price or decreasing the share price is just double the Visa. So then you really need to do the fundamentals. Okay, should I go on to really buy an implied volatility which is high? I mean, at the same time, you do not want the implied volatility to be extremely high as well, because yes, it can go up and above, but it can go also down and all the way to the crust, which you do not want that. So then again, you just need to do your analysis and the things, well, which implied volatility, but it needs to be balanced. You really, I mean, see, the thing is, as an analyst, as a trader, one really needs to look at the companies, compare it to different companies, but as well as compare it to the companies within the industry. If you are looking at a telecommunication company, do not look at the companies which are trading, which are basically in the pharmaceutical industry. Look at the companies which are in the very telecommunication industry. Only then you will see through, okay, then you can go to compare through. I mean, if you really need to do through the fundamental analysis, you got to look by the price by earning, or the price by book value, the price by cash flow, the asset turnover, or the return on asset, or the return on equity, or the beta, or the Sharpe ratio. You've got to make sure that you are comparing to the very companies within the industry, and not to the companies outside the industry, because it certainly does not make sense. Because the rule of thumb is many. The beta is basically the beta is basically 1. If it goes above 1, then it's more risky. If it goes less than 1, it's less risky. Yes, all that standard deviation, all that is there, but you need to compare to those very companies within the industry. Okay, sorry for digressing, but I thought that this is a very important point to touch and cover. So implied volatility is done. Okay, open interest. Okay, I don't really have to write into it, so I don't want to rub it. Open interest. Okay, now what do I mean by open interest? Just by the word open, it means open, transaction is open. So if an open interest in your trading account, be it the Interactive Brokers or the Market Map or the Bloomberg Terminal, or many others. I'm not advertising any brokerage company, but this is what is coming to my mind right now. See that if the open interest is 1, that basically means you have one buyer at one corner of the table, and then you have the other seller at one corner of the table. That basically, when they come to a mutual agreement, when they have made a covenant, when they have made an accord, when they have made an agreement, that means open interest is 1. If you have 10 people on either side of the table, 10 buyers, 10 sellers, open interest is 10. When you have 100 buyers and 100 sellers, they come to a mutual agreement, open interest is 100. So what's the catch over here? More the open interest, the better, because that very company is, people are talking about, and it's thought to be a safe transaction. Okay, we are almost to the end of this topic. You guys must have heard me talking about American option, which has nothing to do with America. Again, European option has nothing to do with Europe, and you have something known as a Greek. Now this is not a Greek option, but it's just Greek. Now in Greek you have the symbols as complicated as you might think. This is delta. This is gamma, opposite of 7. This is theta. This is Vega, and this is rho. Now each of these Greek symbols signify an importance, signify a meaning towards it. You see, delta over here means change in the value of the option price with respect to the change in the value of the underlying asset, which means the equity, which means the stock. Say the example of Tesla. Okay, now how would the figure be? This is your call option. Here you are out the money. Here you are in the money. Here you are at the money, and delta for call option ranges all the way to 0, 0.5 to 1. So basically, delta, as I said, it's the change in the option value with respect to the change in the value of the underlying asset. It basically goes on to suggest that if you're in the money, if your intrinsic value, your delta, which is here at the money, would probably be over here, or would be over here, really depending upon the stock price and the strike price. But in the money, you're basically over here. You're gonna make money. But at the same time, as I said, guys, please break even up. You need to go through the break even as well, because even if you have an intrinsic value, as I said, 1,000 plus 5, 1,005 is a break even. Even if the stock price is at 1,001 or 1,002, but the strike price is 1,000, you still make a loss, because then you have to take into account the option premium. Okay, and if you're out the money, your delta would be here. Okay, now I think so I can draw a figure over here. For the put option, this over here is out the money. Here it's in the money. You have -1, -0.5, 0. You want over here to be negative. Why? Because the stock price is decreasing. Stock price is increasing, so it's 1. Stock price is decreasing, so it's -1. The delta, again, would be over here. Delta might be over here, would be over here. Delta would be over here, would be over here. Really, with respect to the change in the value of the option price, and the option price really depends upon change in the value of the underlying value of the asset. Okay, and again, you have got, okay, you can also draw something like this. This is your expiration. So let's say 30 days is your expiration. Okay, 1 month, 30 days is your expiration. This 30 days is your expiration. That's your delta. Okay, now gamma. Gamma can be defined as change in the price of the delta, change in the value of the delta with respect to the change in the value of the option value, option price, with respect to the change in the value of the underlying value of the asset. Gamma is the highest at the money, because you can imagine the space. See that? Yeah? Gamma, the space is very high. Gamma is highest at the money, lowest out the money, and in the money. The space is less. And our portfolio managers really use and see through gamma in order to hedge their risk. Okay? So gamma really depends upon the change in the straight line delta, whereas delta really depends upon change in the curvature. You see this? Curvature, slant line, really depends upon that. So that's your delta, that's your gamma. Now we are coming to theta. Theta basically means change in the value of the option price with respect to the change in the value of the time value. The time. Over here, theta basically, all it cares is about your extrinsic value. And extrinsic value, as I said, is about the time. So let's just say that more the time you have, more the time, which is basically, let's say at the money, your theta would be over here. Your theta would be over here. It's the highest. more the time you have, and as less time, as it approaches towards expiration, your theta basically decreases. Even it's in the money or out the money, your theta basically decreases. It becomes small. Okay? Now, we come towards Vega. Vega can be defined as the change in the value of the option price with respect to the change in the volatility. Remember, implied volatility. So this is like, for instance, your Vega. Okay, this is your Vega is highest. Say Vega is 20%, this is 10%, this is 5%. Vega is highest at the money, is highest at the top. Vega is highest at the top, and the same thing for the putter. There's not much of a difference. Same thing for the put. So again, change in the value of the option price with respect to the change in the value of the volatility is your Vega. Last but not the least, rho. Now rho is something like this. Rho can be defined as change in the value of the option price with respect to the change in the value of the interest rate. As the interest rate changes, so does the option price increase, but at the same time it is really as well as indulged to the time. More the time, which is, let's say this is 30 days, 20 days, 10 days, more the rho. Basically just like theta, more maturity, your rho is high, as well as, your theta is high, and as well as your rho is high, and rho also is impacted by the interest rate. Okay, now we have come to the end of this video. Congratulations and thank you so much for sticking up with me, for having the patience to go through this. I know this has been a long video. I feel you. I am thirsty. I really want to drink water. I'm not sure if you guys want to drink water, but please feel free to do so. I mean, you see, these were absolutely important concepts. Now, your question might come into your mind, hey Ibad, have you gone on to touch all the important concepts? The answer is no. I am still learning, and I have, I basically work as a financial analyst in a leading independent Swiss wealth advisory asset management firm located in DIFC Dubai. I've embarked my career and I'm very excited as a person. I'm very enthusiastic. Something which really ticks me is something which I'm interested in. As much as I've learned and I've given the opportunity, I thought of myself, why not to give it across on YouTube to the n number of viewers. So stick up with me, and please, by the way, if you have any questions whatsoever, feel free to comment. I will be answering all of your questions, inshallah. And don't forget to hit the like button, to hit the subscribe button, because I will be seeing you in the next video. I wish you all the best. Stay safe. I will be seeing you very soon. Cheers. Thanks.